Today's market moves weren't really about a broad risk-off shift. What markets were wrestling with was a deeper question. Can the AI-driven growth story continue to overpower rising yields, geopolitical uncertainty, and growing structural risks beneath the surface? U.S. equities paused after several sessions of momentum-driven gains. The S&P 500 slipped modestly, the Nasdaq was nearly flat, and the Dow underperformed as more cyclical sectors weakened. But the more important signal came from the divergence underneath the index level. Treasury yields continued climbing, gold kept rising, oil stayed volatile around Middle East headlines, and yet volatility remained surprisingly calm. That combination tells us investors are still optimistic but increasingly selective about where they want exposure. Technology held up relatively well again today, especially the mega-cap AI leaders. Meanwhile, sectors tied more closely to industrial growth and commodity demand, energy, materials, and industrials, saw much heavier selling pressure. So this wasn't simply a stocks down day. It was a day where markets continued separating AI-linked growth optimism from the rest of the macroeconomy. A big part of that shift came from developments around US and Iran negotiations tied to the Strait of Hormuz. Markets spent much of the session reacting to headlines suggesting the possibility of reduced supply disruption risk in oil markets, and that matters far beyond energy prices alone. Recently, oil has effectively become a proxy for inflation expectations. If traders believe geopolitical tensions may ease and oil supply disruptions become less likely, then markets also begin assuming inflation pressures could moderate faster. And if inflation pressure eases, investors become more comfortable extending duration risk back into growth equities. That's one reason why technology and AI leadership remained resilient even while broader cyclicals weakened. But the story becomes more complicated once you look at the bond market. The U.S. 10-year Treasury yield continued moving higher despite equity resilience, and that divergence is becoming one of the most important macro signals in markets right now. Bond investors still appear concerned about persistent inflation, fiscal deficits, and the sheer amount of government borrowing the market will need to absorb over time. The Treasury announced stable auction sizes for now, which helped calm immediate funding concerns, but structurally, investors still seem to be demanding higher compensation for long-duration risk. And historically, rising yields eventually matter for valuation-heavy sectors, especially technology. So, underneath the surface, markets are balancing two competing narratives at the same time. On one side, there's growing belief that AI-driven productivity could support earnings growth and economic resilience. On the other side, there's growing recognition that structurally higher yields may eventually pressure those same valuations. That tension is becoming the central macro story. Globally, the AI narrative remained very powerful today. Asian equity markets surged again, with Japan's Nikkei crossing another major milestone as investors continued pouring capital into semiconductors, infrastructure, and hyperscaler-related themes. Increasingly, institutions are no longer treating AI as just another technology cycle. They're treating it as a broad productivity expansion story. And that distinction matters because it changes how investors think about recession risk, earnings durability, and long-term capital allocation. But it also creates concentration risk. We saw some of that today in semiconductor names. Several chip stocks pulled back sharply after recent euphoric gains, and that exposed how dependent overall market sentiment has become on uninterrupted AI supply chain, spending outlook, or infrastructure build-out. At the same time, institutional money still rotated aggressively toward perceived AI winners like Nvidia and Microsoft. And one of the more interesting signals came from Datadog, which surged after raising guidance. Markets interpreted that as evidence that enterprise AI and cloud spending remain resilient despite broader economic uncertainty. That matters because corporate software spending often acts as an early signal for business confidence and future capital expenditure trends. So institutional capital still appears willing to pay a premium for earnings visibility tied to AI infrastructure and productivity. But there's also a hidden fragility building underneath this environment. Broad indices still look relatively stable, volatility remains contained, yet leadership is becoming increasingly narrow. And historically, narrow leadership tends to create vulnerability because market resilience becomes dependent on a very small number of companies continuing to execute perfectly. One interesting debate investors are starting to have right now is whether markets are underestimating how dependent this rally has become on uninterrupted AI optimism. If yields continue rising while positioning remains heavily concentrated, even a modest disappointment in AI spending or earnings guidance could have an outsized impact on sentiment. I'd be curious how you see this developing. Is the concentration risk already understood by markets or still underappreciated? Another under-the-radar development today came from the IMF, which warned about growing AI-linked cybersecurity risks. Markets largely ignored the warning for now, but it introduced an important idea. AI may not only accelerate productivity growth, it may also increase systemic operational vulnerabilities across banking systems, infrastructure, and enterprise networks. Those types of risks usually don't matter until stress appears, but they can become very important once confidence starts weakening. And that fits into the broader pattern we're seeing right now. Markets remain optimistic, but increasingly that optimism depends on a fairly narrow confidence cycle built around AI productivity, stable growth, and manageable inflation. The broader macro signal from today wasn't simply that equities paused, it was that investors continue believing growth can remain resilient even with higher yields as long as AI-driven productivity continues supporting earnings expectations. That's a meaningful shift in market psychology. Markets are no longer reacting primarily to recession fears. They're reacting to whether productivity growth can outrun structural inflation and funding pressures. Looking ahead, the next major test for this narrative will likely come from incoming inflation data, labor market data, Treasury market demand conditions, and additional commentary from companies exposed to AI infrastructure spending. Investors will also continue watching developments around US-Iran negotiations very closely because energy markets remain one of the fastest transmission mechanisms into inflation expectations. And if oil volatility returns while yields continue climbing, markets may begin reassessing whether current growth valuations can comfortably coexist with structurally higher discount rates. For now, the key signal for markets appears to be that investors still trust the AI-led growth narrative, but that trust is becoming increasingly concentrated, increasingly crowded, and increasingly sensitive to execution risk. But markets rarely move on a single narrative, so I'd be interested to hear how you interpret today's signals. If you enjoy this type of calm, analytical breakdown of global markets, consider subscribing. I publish regular briefings focused on the deeper forces shaping market behavior. Thank you for spending a few minutes here today. I appreciate you being part of the channel.